can you get the secondary market to buy all of that? And then I think we're good, right? No?
You'd have to get the CFPB to change the definition of a qualified mortgage.
No, right. Yeah. So a couple hurdles,
A lot
couple
of other things
small
that
hurdles.
change.
Yeah.
That's a risky product, if you ask me. The average homeowner stays in the house, 7, 8 years? So
now you're making my 100-year mortgage debate.
You talk about it privately. We talk about it publicly. This is the Real Estate Insiders Unfiltered Podcast. Welcome again to the Real Estate Insiders Unfiltered Podcast. I'm your host, Wiggy, along with my co-host, Mr. Uncle Crazy Robinson. Said backwards.
Great nicknames.
Talk to us about, I'm going to read this because otherwise I will screw this up. Pete Mills, really, really cool guest. Senior Vice President of Residential Policy and Industry Engagement for the Mortgage Bankers Association.
Whew. Pete should be getting paid by the word in his title.
Seriously.
My man. Yeah, it was a great conversation. We talked about how the Mortgage Bankers Association helped get the VA changes done when all of the settlement shenanigans started to come down. We talked about the buyer's agent compensation and that applying to IPC or not. You definitely want to listen to that part. And then we also unpacked the Harris housing plan, which isn't really a plan. It's more of an announcement, but we unpacked the details that we have on it. Really fun conversation. Put it in your ears, kids. You're going to dig it.
Pete, welcome to the show. We are excited to have you here today because Keith and I have a lot of questions. We've wanted somebody on from the MBA for a while. We definitely have a lot of questions from viewers and listeners about some of the new rules, what applies, what it doesn't. We're going to cover some of that today. So let's start with having you give our viewers and listeners a little bit about your background. I see, at least if LinkedIn's correct, you've been at the Mortgage Bankers Association for about 12 years, but you've been in the mortgage space since like 1993 in some way, shape, or form. So tell us a little bit about your background, how you got where you are, and then we'll dive into some questions.
Sure. First, thanks for the opportunity to be here. It's
of course.
Interesting time, to say the least.
We got to come up with a better phrase than interesting, because I'm starting to get PT. Whenever I see someone say interesting, I know exactly what that means right now. And we're not supposed to cuss in the first 3 minutes of the pod because it hits it on YouTube. Yeah. So I won't say what we really think. But we got to find a better word than interesting. But yes, continue, Pete. Your background.
Just remember that's a curse, not a blessing.
That's right. That's right.
I have actually been in this space for 40 plus years. I came out of college out of UC Berkeley in California. I got what every kid with an econ degree wants, which is a job at the Federal Reserve Board in Washington, D.C. In their research and economics division. And I ended up being on day one, they assign you to a particular section in the research division. I was assigned to mortgage and consumer finance. And I have spent 40 years trying to escape, and I haven't been able to.
Do you have Jerome's Powell's cell phone number, and can we text him?
I do not. That is a highly guarded secret.
All right.
But, my career has taken me from there. I actually have realtor blood in my realtor organization blood. I worked for the California Realtors for 5 years after I left the Fed. I went to the California MBA for a while, toured through the private sector, including a couple of major financial institutions, one called Countrywide.
Look at Keith's face.
I can't hide it.
That was, for those of you who are not here in 2008, the awkward silence was related to that, but we'll keep going.
Keep going, yes. And then again, the last 12 years have been here at the MBA. Again, all that work has been in the regulatory policy space for the most part, and political advocacy and the like. So it's been a great ride. I've been through essentially the post-SNL crisis, through
for the millennials, that's savings and loans.
Yeah, savings and loans, not Saturday Night Live.
Not Saturday Night Live.
Though Saturday Night Live has some crises as well.
That is true.
But Pete did not help with those.
Yeah.
So I thought the GFC, the Great Financial Crisis, would be my last, but then COVID came. So
I remember.
It's been a fun ride.
Yeah.
Well, in real estate, we've gone from one crisis to the next. It was COVID. then lawsuit settlement, and it feels like the crisis is just somewhat started.
Stacking up. Yeah. Hey, I've got a question with your background, because I've always been curious. I've been able to ask people on the real estate side, but I've never been able to ask someone on the Mortgage Bankers Association side. How closely do you and NAR work together? Like, do you have a weekly conference call and you get on there and share ideas, or is it as needed? You put up the bat signal when you need each other? How does it work?
It's a little bit of both, to be honest. We do have some regular check-ins that we do, but it's mostly personal relationships. I've known the people that work there for a long time. And, when there's an issue where we have common ground, advocacy works best when you've got alignment across industry segments and the like. So we do spend a lot of time talking and just checking in on issues and where are you guys on this? Can you help us? I think, we work very closely together. We are most of the time aligned. We may have different priorities. Something may be in a different spot in our priority stack, but we are generally very well aligned, whether it's tax issues, flood insurance program. Most
the recent VA working on getting the VA
some
changes.
Of the work on the VA and the GSEs, all that has been done in a lot of coordination. During COVID, again, a lot of conversations around how do we get transactions done when the appraiser can't go into the house, for example. So a lot of those issues are all common ground for us.
I just find it's we'll come back to this for everyone, but Keith and I keep having these conversations about how much what we're referring to residential real estate has no idea how important the advocacy work is that's going on behind the scenes. And it'd be good for you to talk about that, because sometimes when they hear from the same people all the time, they just kind of tune it out, but somebody from a different sector explaining it could be really good. Let's do a couple rapid fires just to everybody get to know you a little bit. Keith, kick us off.
All right. Favorite book or podcast this year or ever, or however you want to frame it.
This year I started listening to Michael Lewis's podcast on Sam Bankman-Fried and the FTX blow up and all that.
It's a good one.
But what I did is, it's actually, I actually tracked back to, I think it was the prior season 3, and it's about expertise and where you find an expert. And he has some really great vignettes in that. It's about 7 or 8 podcasts about experts are rarely where you think they are in your organization. There's this concept about 6 levels down. And when you have an organization experiencing a significant operational challenge, the people that can fix it aren't the CEO or the highly paid outside consultant from some big fancy firm. It's going to be somebody 6 levels down that works on it every day, knows all the workarounds to make things work, even if they barely work, and they're the ones that can help you fix the problem. It's a fascinating series.
It is really good.
I think 8 episodes. It's really good.
It is. I listened to that as well, and the Sam Bankman-Fried one as well. That's a great recommendation, one we haven't had. All right, James.
We have a list, just for context, on our website. We always remind people of all the books and pods people recommend, so you can kind of go see it from all of our guests. It's actually a pretty cool list, and Keith buys every book that somebody recommends if he hasn't read it. So
that's a fact. Yeah, nice.
He's a great storyteller. So all those episodes are good.
He really is.
All right, my question is: if you could have lunch with one person, current or historical, who would it be and why?
This might. I always think that question in terms of I'd want to have lunch with somebody who made some momentous decision that sort of changed the course of the world. How did they get there? And so I would think of somebody like a Harry Truman, and I say that only because my father passed away recently at 96. He was in the war, and he didn't talk about it much as a kid growing up, but in his last few months, we talked about it quite a bit. And he told the story about he was 17 and a half years old. He joined literally weeks before Victory in Japan Day. He was in boot camp, and the whole idea of Truman struggling with sending troops to a land invasion of Japan and how you probably lose 1 million more people. How did you get to that decision? And I exist today because somebody made a decision like that. Who knows what would happen? But it's just one of those one of those issues that that would be a fascinating conversation.
That's a good one.
That's a good one, and also one someone hasn't shared. So I love hearing that, and thanks for him. He's not here, and my father's not here as well. But thanks for serving. So we'll say that to him. My dad was in the Navy as well. So
I appreciate it. Yeah.
Well, look, let's dive into a lot of the stuff that we got going on. And
there's something going on.
There's a few things. I'm actually going to start with the first question because then Keith will follow up with the same category. There's been some confusion going on in the space around the difference between a concession and IPC, interested party contributions, and whether so that form of getting buyer's agents compensated versus whether it's written in the offer and the seller pays it directly through the closing process. And so my understanding is, from what I've read from Fannie, Freddie, and FHA, that if the seller pays the buyer's agent's fee through the closing process, that it doesn't affect IPC. There seems to be some confusion. Can you clarify some of that for our viewers and listeners?
So I think you got it right there. I mean, that it is at the time, and we worked with NAR on this issue quite a bit. And at the time, we didn't know how buyers and sellers would react. We knew there were a couple of different ways that sellers could continue to make offers of or to pay buyer agent compensation. When we went to speak to the GSEs and the FHA about those issues, there wasn't a distinction made between a seller contribution or a off MLS cooperative compensation deal. So that was not distinguished between the two. We talked through the process. As long as the compensation paid by the seller, either through the agent or directly to the seller, was reasonable and customary, it wouldn't be an issue. It would not count towards the cap on IPCs. So that's our understanding of it, and I think you've got it right.
Okay. Yeah. All right.
Key language there is reasonable and customary, right? So like, so long as it's similar to the way you've done it in the past, you can continue to do it in the future.
Yeah, I mean, if you negotiate points of compensation for your buyer agent, it's not going to
work. might be pulled into a meeting. Okay, follow-up question to that fact. So, Pete, I'm about to make you the great and powerful Pete Mills, and you now have your magic mortgage wand. And if you could get buyers able to finance their commission, would you? That's my first question.
Their buyer's agent compensation.
Yeah, their buyer's agent compensation. Yeah. So if they could just raise the concession by whatever percentage to cover the buyer's agent commission, would you? First of all, first question. Not possible today. Do you think it will happen? And then if you do think it will happen, how long will it take? So would you? Will it happen? And when?
So would I? And I hate to answer a question with a question, and maybe we can come back to that later. But I'm not sure we need to, but we'll come back to that maybe. As a lender, I would have concerns. I'm not sure we're addressing affordability necessarily. I think there's going to be some significant affordability impacts if you roll agent compensation into the loan balance. You're going to be dealing with obviously a higher monthly payment just by virtue of a larger loan balance. You're going to deal with loan level price adjustments from the GSEs. You're going to deal with probably the biggest, if it's a conventional financing, higher MI costs. So your 90 LTV loan becomes a 90 plus LTV loan. Your 95 LTV loan becomes a 97 LTV loan. All of that drives cost of MI, drives much higher monthly payments. May not solve
for it to work. Yeah. So MI is just mortgage insurance, just in case someone who's listening doesn't know that. Yep. No problem. No, totally fine. And then, I guess just increasing the amount, you'd have to increase everything across the board, or it is. Yeah.
And it may not solve the affordability issue. MI is not cheap. It's valuable. It's important. It gets people into houses. Right. But it does have a cost implication as you climb that LTV ladder. On the portfolio lender side or on the GS, who holds that risk? So GSEs, portfolio lenders, for example, the FHA insurance fund, you're going to have low down payment borrowers starting out their journey with less equity. So you're eroding their starting equity position. That's going to drive higher foreclosure and default costs through the system. So there are a lot of challenges in the space. I think until we see a real compelling need to do something in that space, and I'm not sure rolling into loan back, maybe there's other ways, haven't thought of it yet. But there, financing for 30 years is a real challenge.
Do you think that, let me ask you this then, as just a follow-up to it. Obviously the plaintiffs' lawyers have an agenda. They believe that all of these things are going to bring the cost of housing down. We can all debate the merits of that, but is the current system that was in place the right system, or do you think these changes are a good direction? I mean, I guess my question I'm trying to figure out is what happens if a buyer is now having to make a choice of being unrepresented because they can't afford representation? I feel like that's a really bad idea.
I think I totally agree that's a bad outcome. We look at this from a principles-based approach, and buyers who want representation should have representation. I think that's an important principle. Again, I don't know that sellers are going to en masse refuse to entertain paying borrower agent compensation. But I think that having that ability to negotiate over the buyer agent comp, I think a good listing agent should be able to convince a seller why it's important to consider that. Mm-hmm. And that's why I'm wondering if the question is premature. And I've heard people talk about Northwest MLS, and that 90 some odd % plus of the transactions still go down with the seller paying the buyer agent comp. So yeah. Do we need to go down this path is an open question, I think.
It's a fair answer. And to be clear, Keith and I are both we understand this really deeply, probably more than like 99% of the people in the industry. We're not actually opposed to this new methodology because we do believe that that buyer and that buyer agent are going to negotiate a rate that is commensurate to service, whatever that is. And we've said this 1,000 times, sellers want to sell their damn house. Like they're going to figure out how to do it. The only downside could be in very competitive offer situations where, veterans, low-income Americans, minorities could be harmed in that. And we're obviously going to see what that plays out, unfortunately. But
I guess what I don't understand, and I want you to do it like with crayons so even I can understand it, because I don't see a wild difference between the seller paying it, right? Like, so the seller's going to receive, let's go ahead and do a real life scenario. Seller's going to receive 4, 5, 6 offers. There might be an all cash offer that's lower, but you'll have a financed offer that's higher. And so they're offering more money to make their offer more attractive because it's all about the seller's net. So the buyer they're still, I mean, if you think about it through that lens, they're still financing, right? The commission or the compensation?
Yes and no. I mean, I would say if you look at it, I remember this from one of my econ classes. You do an excise tax analysis. Excise taxes paid by producers don't get fully passed on to the buyer, don't get fully absorbed by the seller. And I think real estate commissions are the same way. It's not like you decide your house is worth $500 and then you add on 5.5% for the commission.
Sure.
The value is the value. I've heard Consumer Federation of America talk about, home prices are going to come down by 3% magically. I don't.
Not so
I don't
far.
See that.
Not so far.
We literally just had Steve Robeck on the pod. Mm-hmm. We literally just had him on the pod to talk about that very thing. We're like, no, that's not how that works.
Yeah. Why would the seller do that? The seller wants to capture at least some of that. Right. That's the benefit to the seller. So I kind of view this entire exercise with the litigation and the CFA support of it is sort of like the dog that catches the car. It's like, okay,
now that you caught it.
The
only part that makes where there could be a savings to the seller is if in this new model, buyer agent and buyer agree to a rate, whatever that is, for their services. And if the seller says, instead of advertising anything in advance of an offer, they're like, just submit whatever you want in your offer. Obviously, with the buyer's agent not being able to charge more than what they agreed to in the buyer rep agreement, that could potentially save sellers money.
Do new business models come out of this, or do buyer agents get more competitive? Sure. I mean, those are ways that maybe the transaction costs come down over time.
I think my point really is, Pete, and I think we're saying the same thing. We're just coming at it maybe from different ways, but affordability really is a two-prong approach, right? There's the monthly affordability, what's it cost on a monthly basis. And you're right, a buyer financing their buyer's agent compensation would increase that. But there's also cash out of pocket or down payment, right? That's the other affordability issue. Right. The thing that I'm most concerned with is affordability for the entry. Like, I'm even fine if it's a structure just for a first-time home buyer, right? And, get Uncle Sam to chomp down on more of the risk, because they're the one really consuming the risk anyway. So, get it backed by Fannie and Freddie so that you can sell it on the secondary mortgage market. So that what I'm most concerned with for the overall health and welfare of the industry is that as many first-time home buyers get access to properties for that wealth creation event, the largest for most folks in their life, right? And so anything that makes that harder, I just immediately want a solution for. So that's where the driver comes for me around that thought process.
So you're basically of the stance, let's wait and see how this all shakes out a little bit, and then
which is a fair and prudent approach.
I don't disagree with that. Yeah.
It's a terrible market for this to be happening right now, when you've got a seller's market, no inventory, prices have been run up over the last few years. It's a really bad timing. I wouldn't want to make a decision about this in the worst time to make the decision, and then
that's fair.
It dissipates. But Keith, to your point, if this path is pursued, I do think it needs to be very tailored to certain situations. You would not want to say, okay, we're going to finance everybody's commissions now. There's no other industry where one industry finances another industry's comp that I can think of, but there might be one out there. But I think it needs to be a targeted approach.
What?
That's who brought this too.
Right. What? Plaintiffs' lawyers or pocketing defendants' lawyers' pockets? Don't get me started.
Merlin, mark the tape. We're 20 minutes in. It took James 20
Come
minutes.
Come on, Pete. That was funny. Like, it made sense too. Like,
that was a good one.
Yeah, you found one.
It's an easy one to target. So talk about an industry that props each other up. Keith, let's move this off before I go on a soapbox and get us all canceled.
I love it when you get all riled up, though. All right.
So rates.
Yeah. So
we're talking about affordability. So let's talk about rates.
So rates have been trending down. Fed sort of flirted with, I think, came out and said they were going to do a rate cut in September, debating on whether it's 25 or 50 or how much between now and the end of the year. First of all, do you think the downward trend on rates continues? And then two-part question. I got to work on asking one-part questions. But do you think the downward rate trend continues? But he's going to say yes to that right away. And then where does it start to unlock this pent-up demand from a buyer? And where does it start to, and these could be different, pent-up demand for a buyer, and where does it start to remove this lock-in effect for a seller?
So I'll do the first one first. Yes. We are now looking at 3 rate cuts between now and the end of the year.
3? All right.
From the Fed. First. Big question, 50 versus 25 in September. That's going to be totally data-driven.
Do you have a call on total cuts by the end of the year?
I think our chief economist is looking at a sort of neutral Fed funds rate, about 3.5%. Okay. We're in that 5.25 to 5.5 target range now. We hit that sometime in 2025. You got to remember, though, some of the mortgage rates have already priced that in. They've already priced in like the first chunk of that. So it's not like every time the Fed moves, you're going to see a downward trend.
Right.
But we do see rates declining through into 2025. I don't think we see a 5 handle. Mike Fratantoni, our chief economist, is talking about mid to late 2025 for a 5 handle.
So five handle just meaning sub 6% in interest rate, right?
Correct.
Yep.
Correct. Yeah.
And is that the range where you think things start to really cook? Like we start to really?
I think if we hit a 5 earlier in that time period, as you hit the spring home buying season, I think that's a good thing.
Mm-hmm.
But for the lock-in question, that's time and life is going to make that change. People will get married, they will take new jobs and have to relocate. I think the number is something close to 80% of homeowners have a mortgage rate less than 5%.
Yeah.
So they're going to move for reasons other than rates crossing some threshold.
Right.
They're going to move because life is going to make them move.
We're still doing 4 million sales a year, and that's just life decisions. Right.
Yeah, right. Correct. And, people have peppered me about how come we can't get rid of due on sale clauses and make all mortgages portable. I just may just say it's not going to happen, and I'll leave it at that.
Because banks don't make money.
Yeah.
By the way, that view was Keith Robinson, not Pete Mills or anyone from the Mortgage Bankers Association.
Right.
All right, cool.
Constitutional issues around changing contracts. You've got trillions of dollars of mortgages predicated on there being a due on sale clause. You just can't make it go away.
That's not how the world works.
Product-wise, so I don't know what product is out there that would help. The only one I can come up with, and because I'm getting to that age, is the HECM, the reverse mortgage, the reverse for purchase product. Yeah. Where you have a lot of equity accumulated because you've been living in your house for 20 years. You refinanced in 2021 at the bottom of the market. You had all this equity. You could go buy a house with a reverse for purchase option and not have a mortgage payment. So, that is an option, but that's not for everybody, and it's not a panacea. And so that's why I land on time and life taking care of this over.
I do agree. I'm going to push back just a little on that because otherwise podcasts are boring. But I did look it up. 89% of borrowers have a rate below 6. 78% have a rate below 5. And 60%, 59.5% have a rate below 4. But some of those people have had life events where they wanted to move but couldn't afford it, right? So there is a backlog of some percentage of listings that every time we have a 1% rate move down, some of those people who had the desire because of a life event but literally couldn't afford it will become more affordable now and can cause a trigger. There's some backlog, whether it's
absolutely. And it's just the great unlocking, maybe not, but certainly again for certain borrowers and certain financial profiles, it's going to make sense at 5 3/4. It doesn't make sense at 6 3/4. Absolutely.
I think everyone needs to stop looking for a light switch, right? Like it's not a light switch, it's a dimmer switch, right? So every quarter point or half a point that rates go down, it's going to get a little brighter in the room, right? And
dials, not switches.
That's right. Dials, not switches. Yep.
So let's talk about, I'll ask this. I know Keith's going to have a follow-up that he's going to want to ask about the presidential candidates, but let's talk about we're continuing to try to find ways to get canceled on the podcast. We have this conversation about how far we can push things.
Yeah, I'm excited about the comment section when I ask this one.
I don't mind if you guys get canceled. I do mind if I get canceled.
It's okay. This is a non-profit podcast. So what would you do to solve affordability issues? Like if you could, as Keith said, you're now the affordability czar for the United States government. What would you do? What would you implement to try and solve some of these issues that we're having? And then we'll go to the next question that Keith wants to ask. So,
to Keith's point, there are no silver bullets here. There's a lot of different things that have to happen. I think a lot of I do think it's a supply story. We went, 10 years post Great Financial Crisis, dramatically underbuilding every year. The starts numbers. I'll give you one weird example. When I started at the Fed in 1983, I used to call up every month and get the starts number to write a memo to send to the governors. They'd get it a little bit early before the public got it. And at that point in time, starts over 1 million starts that was and if you're trending above that, that was positive. If you're trending below 1 million starts, that was a bad thing. That was 1983. We went from 2008 to, I believe, 2019, never being over 1 million single family housing starts with a population that's much larger.
Right.
So we dramatically underbuilt for a long period of time. So supply is the issue. Not a ton you can do at the federal level. We can come back to some of what I think Keith's going to ask later.
Yeah.
But a lot of it is local government. How do you get local government to be receptive to higher densities, to mixed use, multifamily mixed with single family, duplexes, ADUs? How do you streamline permitting? How do you, you're from California, Jim and Keith, you both know, to develop a large single family development, you got to build a school, you got to build the roads, you got to build, you got to issue Mello-Roos bonds to build all that stuff. All of that's adding to the cost of housing. So that I think a lot of the issues are going to be local. You've got land, you've got labor. The labor's an issue. A lot of talk about trying to unleash federal lands for more building. That's part of the solution. But there's a lot that has to happen for this to really take off.
Do I get to float my mortgage idea, James?
No.
Pete, I used to try to espouse for 100-year mortgage, and people thought I was crazy. Don't laugh. I have a new one. So, 45-year mortgage, first 15 years are interest only. And I'm fine if it's only for first-time home buyers or it doesn't have to be available for everyone. But that way they've got a long enough runway at a lower payment so that they should have equity on the other side of it. Not no matter what, but nearly no matter what. And most people's incomes should grow over a 15-year period. 7 years isn't quite enough. I think 10, you could probably get away with it, but 15 would be really safe. So can you get the secondary market to buy all of that? And then I think we're good, right? No?
You'd have to get the CFPB to change the definition of a qualified mortgage.
No, right. Yeah. So a couple hurdles,
a
couple small hurdles.
Yeah. That's a risky product, if you ask me. The average homeowner stays in the house, 7, 8 years? So
now you're making my 100-year mortgage debate because you might how is it risky if they're going to be out in 7 years? All right. I'll get off this soapbox.
Sorry, Pete. He does this with anybody who's in the mortgage industry.
I do.
It's constant.
You're welcome, audience. I'm sure they're sick of it too.
Having lived through the great financial crisis, home prices do actually sometimes go down.
That's why you need 15 years. That's why you need. All right.
He's not gonna let it go. All right. Ask your follow up, Keith. I know this is what we want to do.
Yeah. So I am the least political person that I know. So I'm surprised I'm asking the slightly politic based question, but it is about housing. So Harris released her housing plan, or at least her thoughts around a housing plan. What is it, high level, and then what are your thoughts about it, or the Mortgage Bankers Association's thoughts about it?
Yeah, well, first of all, I guess I would say it is a campaign announcement, so there's not a lot of detail.
Yeah.
But from a high level, I like the fact that it was supply focused. A credit for builders who build affordable housing, however you define that. That sort of puts the gas on the supply pedal, if you will. That's positive. There are other aspects of it. Again, not a lot of detail. $25,000 in down payment assistance, and that's the demand side. And I do think it was interesting. It was a couple of the write-ups of it did suggest that they were going to hold back on the demand stimulus until the supply came on market. That would be smart.
Yeah.
If they did it that way, if they could stage it that way. $25,000 for first-time buyers, a higher number for first-gen buyers. So I think those are some interesting ideas. A lot of it is in the execution and the timing, and the look, the big challenge here is the cost.
I was going to say, who pays for it?
Taxpayers, James. That's how it works.
Pay for it. Yeah. And
it's rhetorical, but yes. Yeah.
Yes, exactly. And to your earlier question about affordability, the fiscal situation is a significant driver of higher rates, just a higher level of equilibrium rates. So that's going to be a challenge for us in the years ahead. We've got, interest on the debt is larger than a lot of our discretionary spending items.
Yeah.
And it's a big challenge. So who pays for the tax credit for the home buyer down payment assistance grants is a big question. So I think a lot of this stuff.
I was listening to an economist. I listened to an economist who was at a Senate hearing talk about.
That sounds like you need a new hobby.
It was not intentional. I don't know how I got onto it. Something at 2 a.m. when I can't sleep. And they were asking questions of how much we'd have to cut spending in order to get things back in line. And it was, I think he ended up we'd have to cut every single thing in the federal budget by 15%. And it would take 10 years for things to start to realign themselves. And I was just like, oh, yeah. That's a big number.
I
mean, that's a driver of, we talk about the mortgage to treasury spreads and why they are historically wide. Mm-hmm. And again, this is one of the factors that that is keeping spreads wider.
But a big piece of that is not you and I. Well, you have an economics background. I just read a lot, but I mean, the biggest driver of that is really the Fed, right? The moves that the Fed made.
Yeah, I mean, certainly the run up over the past 2.5 years. Yes, that's a Fed driven.
Can I debate with you the supply side thing? Because economists always say it. Like I talk about my crazy mortgage products, and they all, like you, look at me like I've got 57 heads and I'm crazy.
You can include me in the same. Whatever. I'm in Pete's camp.
That's fine. But we're not like. Can we just be honest? Just no one's listening, right? This is a tiny little pod. We're not going to solve this with supply side. Like it's too complicated. The federal is, even if they try to roll something out, it's still going to be up to local municipalities. And on top of that, you just talked about how builders don't build unless the tax incentives are massive for the builders. Builders build houses to make money. They don't build houses to make them affordable. Now, we could debate whether or not they should be and, philanthropic and all that sort of stuff. But you would think, since we've been talking for a decade now about how we aren't building enough houses, builder would be like, well, hey, if these are selling for more, let's just swing hammers faster. But they aren't. And they aren't because they are going to be very thoughtful about how they deploy their capital, and they're going to make sure that they make money when they build houses. So unless this tax incentive is monstrous, it's not going to be enough to incentivize a builder. Just going to go, I'll just go build what I was going to build anyway. Right?
Even if they build upscale, people are moving. I mean, I think just supply, even if it's not targeted supply, is better.
Got it. Yeah, more supply is better than less. Sure. Okay.
Correct.
I can
agree.
People
move up into the new homes that may be more expensive, but that opens up a home. So I think supply has to be part of the answer. I don't think any one of these by itself is enough. So again, I think one of the proposals, no details.
Right.
And this has been a proposal, frankly, on both sides of the aisle for years, is how do you redeploy federal lands for housing purposes? So,
sure.
Could you donate land to affordable housing builders, for example? Couple that with tax credit. You have to pull together multiple. It's no single program that's going to do it. It's going to be knitting together multiple initiatives at the federal, state, and local level to make it work.
And I am at least thankful that she has put out an announcement. That's the beginning of a plan, right? Whereas many others have not, right? So look, and I'm sure
housing is important.
I can already hear about the comments section. That's cool. Come at me, y'all. I'm ready. But at least she's talking about it, which is something. And I hope they all start talking about it, because to me, that is a massive platform issue for the overall health and welfare of the economy of the United States.
Yeah, in fairness, RFK did as well, even though he's obviously now endorsing Trump. Keith and I were actually present for his announcement. It was unintended, but we got to listen to him talk about that. I think a lot of it, to your point, I think it's all in the details. It's just sort of campaign stuff right now, and it's always in the details at this point. But it's, at least it is a talking point now, and it's becoming a pretty big headline. And obviously, I think that they're going to have to figure out how to solve some of this, because it's just becoming. I mean, you were from the Bay Area. We're going to talk about Brock Purdy in a minute. In case anybody couldn't figure out where he's from. So
I'll get you a Raiders guy before our next podcast.
Where Keith and I live, and you grew up here, like the cost of housing is so stupid. Like it's unbelievable. Like I'm looking at houses for sale that are like 4,000 square feet. You put it in Texas, it's going to be like 750, and it's $4.5 million. You're like, what is going on? I mean, it's just insane.
My mom is living in the house I grew up in.
She ready to list it? We need inventory.
He bought it for $26,000 in 1959. I don't even know what it's worth today, but it's still the same.
We could throw it on the market and find out, Pete.
California rancher.
Yeah.
All right. Last couple questions. I'll ask one, and then Keith will take us to the finish line here. So you've obviously heard about all the stuff on the real estate side. You're acutely aware of all that and been working with NAR on some of those things too. How are you advising the mortgage industry to approach the real estate community with all of this? Like what should loan officers be doing? What should agents be doing? We'll kind of combine it. Like what should they be doing more together with all of this change?
I mean, a lot of it is, it's interesting to watch this unfold, because in the mortgage space, if the rules change for us, it's coming from a regulator. They come up with a prescriptive rule with an effective date, and we all kind of switch over at the same time and kind of pretty much do things the same way. This is really challenging. When I look at the buyer agent agreement, and firms have their own, local associations have their own, state associations have their own, MLSs have their own. They're all different. And I think how a buyer thinks through that process, and then when it gets to the lender, it doesn't look the same. It's different in different jurisdictions. Mm-hmm. Different companies have different disclosures. So I would, one of the challenges is to try to get some consistency. So I think education's got to be the key. I think the thing I worry about the most is the surprise at the closing table, that the buyer signs an agreement to pay a certain amount. They look for 3 or 4 months. They finally get the house. They write the offer, and they didn't at that point in time remember to negotiate over who pays that compensation. You get to the closing table, we're short cash to close. Either got to rewrite the deal, requalify the borrower. Maybe they qualify, maybe they don't. So I think that education on both sides, on the real estate side and on the mortgage side, to avoid that outcome. I've been frustrated when you watch the DOJ's position on this stuff. Why can't we have a field that says seller willing to consider paying buyer agent comp? Not an amount, just I'm willing to consider it. I may not do it. I may decide not to do it. It doesn't put the thumb on one side of the scale or the other. It just says, yeah, look at it, bring it to me. Mm-hmm. To make the search process more efficient. And how do you make those buyer disclosures work in a way so that the buyer's not wondering, well, I'm agreeing to pay you 2% or 1.5% or 2.5%, whatever it is, without really having a conversation about, okay, how am I going to pay for that at the time you sign? So how do we get the processes to work? I do think it's a time issue. I think we'll all get better at it on both sides, on your side and our side.
It'll standardize over time.
Things don't change radically.
And we've been saying vocally that while the real estate agent and the loan officer's relationship has always been very important, the level of communication now has gone from, used to be, I'd talk to you, you tell me they're pre-approved. It wouldn't 3 months later, no, whatever, right? You'd update me, a big job change or something like that. Maybe it would change. But for the most part, pre-approved is pre-approved. Let's go find them a house and support them through the process. And now, basically, every time you write an offer, you should have a phone call with your loan officer on structure for that particular borrower. So that relationship between real estate professional and loan officer needs to become highly, highly, significantly more communicative, to where you're working on it every time you craft an offer so that everyone is fully in alignment.
Yeah, I think that's important. I do think that loan officers are going to be concerned about, we don't want to give advice on the deal.
No, sure.
But how the structure of the deal affects your financing, that's the conversation that has to happen.
Yeah, doing it together, right? Both of us, all of us on the call together. Yeah. All right, we'll take us out with the question we always end on. So congratulations, you're no longer with the MBA. You now own and operate a real estate brokerage. You're welcome, Pete. Well, if you were running a real estate brokerage, or if you were a real estate agent today, what would you be implementing or focusing on? What would be the number one thing to help your business?
I think it's kind of the same answer. I think the worst thing that can happen for a real estate agent, and for a loan officer for that matter, is a deal blown up at the closing table. Nothing crushes your reputation more than that. So I'd be getting that. It's educating my agents, and it's getting a really, really good buyer agent agreement that's bulletproof,
clear,
in terms
concise,
of the buyer knowing exactly what they're in for when they sign it. And that mistake at closing, we forgot to, that's the thing you got to avoid. That's the one thing I would do.
You know, great comment, and I'll follow up with this. I was on a panel with my friend Linda, and she put in her buyer rep agreement 2 check boxes. First one says, I am going to be paying my buyer's agent directly. Second checkbox is, I'm instructing my buyer agent to request the seller pay the buyer agent financing. The language is off slightly, but you get the idea. It's very clear. Simple. I'm paying you, or you need to get the seller to. I am agreeing to and telling you to put it in the offer or ask for a concession. So it's 100% clear up front. Box A, box B, the end. Yeah. So it was smart on her part. I got to give her credit for that. So
totally agree.
Pete, thanks so much for being here. It was great to have you. We really enjoyed your insights on stuff. You gave a lot of clarity on some things for our viewers and listeners. I'm glad you didn't take Keith's 100-year mortgage idea and run with that.
First of all, it's 45-year mortgage now with 15-year IO. Okay, don't
shifted from 100 to 45. So next month it'll be 50.
I'm gonna keep playing with this till it's gonna land one of these days.
And again, thanks for all you do, by the way. Just wanted to state that on the advocacy side, I think our industry needs to be much more appreciative of the advocacy teams, both on your side and on our side, for giving us the ability to do what we do in our professions. Without you, we couldn't do it. We know that Congress would screw everything up. So we appreciate that very much.
Yeah. Thanks, Pete.
Appreciate your voice on that point. As I saw your interview with Shannon a couple weeks ago, and
you still came on.
What's that?
And you still chose to come on with us. We appreciate that.
That's the challenge, is to try to keep everybody focused and engaged in the process. It's really important.
Yeah.
So joining your state association, your national association, really, really important.
Yeah. We appreciate all that you do, and we'll have you back on. I'm sure there'll be more drama for us to talk about in the future. So
for sure. Absolutely. Thanks, Pete.
All right. Thanks, Pete.
Good. Thank you. Appreciate it.
It's our job to say out loud what everybody's only thinking to themselves. It's your job to subscribe to this podcast so you never miss an episode.